Without working any harder, without taking any additional risk, without losing control, and without changing your cash flows, I'm going to show you how to put rocket boosters on what it is that you're already doing. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. Today's subject is going to be IBC, the infinite banking concept, as rocket boosters for life. Pun intended. Let me just simply start by saying that this idea of becoming your own banker is not a get-rich-quick scheme. That's me saying that. That's R. Nelson Nash, the author of the book, Becoming Your Own Banker. That's him saying it. It's not. I've been practicing this idea personally for over 7 years now, going on 8 years now, I suppose. And we didn't get rich overnight, but we certainly did do those things without taking any additional risk, without changing our cash flows, without losing control, without working any harder. We implemented this idea, and what I found to be true is another saying from Nash's book when he said that this is the most profitable thing that you could choose to do over your lifetime. Reassume the banking function in your life. Account for the banking function, own it, control it, manipulate it, use it. Over these past several years, because we're still on our journey, we're several years into it. We've got many, many more to go, I hope. I commonly tell my wife that I'll be called middle-aged when I'm 60 because it seems apparent to me that 120 years is not inconceivable from what I gather from scripture, and people are living longer anyway, so I'm just rolling with 120 lifespan. When we talk about whole life products, we even talk about 121 products that mature 120 years of age, at 120 years of age on the person. So when I talk about being middle-aged, I'm talking about 60 years or older. So that should be heartening for everyone listening. If you're not 60 yet, you're not even middle-aged. And if you've peaked above 60, you're just now barely middle-aged. So in considering what Nash said about it's the most profitable thing that you could choose to do over your life, we've got several years of experience of seeing what it looks like to have compound interest working in your favor, to have access to capital, to have mutually beneficial relationships with multiple insurance companies, because we have a system of several policies now. We currently have 6 policies, and like I say, with different mutual life insurance companies. So we've just been able to experience firsthand. And again, I guess I'm giving you Nash's information. He would say that more's caught than taught. The way I normally talk about this idea is comparing it to a bicycle. It's one thing to watch someone else ride a bicycle. You may even become enthused by watching, inspired by watching, motivated by watching someone else ride a bicycle. But there's something about getting behind those handlebars yourself and taking off down a hill, pedaling the pedals and everything. There's going to be more caught than taught with this idea for sure. But it's not get rich quick, but it most assuredly is the most profitable thing that you could choose to do over your lifetime. And I'd like to talk about that a bit more in depth. Again, I know that everyone has a different come from, meaning you might be an employee pursuing your career, growing a family, whatever that may look like for you. You may be running a business that you own and control. You may be a specialist in some field. You might have a big business, 500 plus employees. You might be a full-time investor, part-time. I don't know. But what I'm going to suggest here is that if you are in the business of doing whatever it is you're doing, consider that since everything is financed, because it is, what if you were in the business of financing what it is that you're doing as a household, as a specialist, as a business owner, as an investor, whatever it is you do? What if you were in that business of financing what it is that you're doing? Because again, everything is financed. If you've not heard me say it, it's one of two ways. Very simple, very straightforward. Either you're borrowing someone else's money on their terms and conditions, beholden to them, paying them interest, etc. And that's if you qualify, right? The whole rigmarole. Then There's the opposite, which is you set aside capital, you set aside money somewhere. A good question to ask is where? But you set aside money somewhere and it's stagnant, maybe it's at risk. There are things to consider there, but you set aside money until you have enough to buy whatever it is that you want to buy, finance whatever it is that you want to finance. And the whole time that is taking place, because you certainly must put a cost to the value of your time. The whole time that you are accumulating that capital with that money, you are forfeiting the opportunity to compound. So you're forfeiting the opportunity to earn interest. So those are the two ways to finance. So again, if you could assume that role for yourself, reassume it. Okay. Well, no, perhaps I was right. I should say assume, because the system, the paradigm that we're born into has us beholden to third-party lenders. Maybe we've got a bit of a step up to where we've been told to pay cash for everything, and it's better. It's certainly better than paying interest to someone else, not to pay interest. But again, for all my cash is king folks, don't overlook the cost of capital. Capital has a cost. If you're not sure about that, would you loan $1 million out for nothing? It's a good way to consider that. So everything is financed. What if you were in the business of financing whatever it is that you are already doing? It's not get rich quick, but it's certainly the most profitable thing that you could do in addition to whatever it is that you're already doing. So again, going back to what I said, without changing your cash flows, without having to take on any additional risk, without losing control. I'm actually telling you to take control, and I'm showing you how, okay? So in that way, you can become your own banker. So what we're talking about then is just adding one thing to what you're already doing, becoming your own banker. Nash would call this creating the entity, okay? When I talk about the entity, I'm talking about a properly structured whole life policy with a mutual company that pays dividends. There are lots of reasons why I say that exactly the way that I do. If you've not heard me say that, again, I can encourage you to read Nash's book, to listen to the other information on this channel and podcast. Mutual life insurance companies make us part owners of that company. When that company experiences good performance, we get to receive dividends by being part owners in that company. And what I'm saying is this policy that's properly structured for the banking purpose is going to be a private asset. It's a private appreciating asset, perfectly collateralized. And that entity, that policy, is what we can use as our bank. And of course, if we're talking about a system of policies over the course of time, then a system of policies for our banking system. So by adding one step to what it is that you're already doing, again, without working harder, without changing your cash flows, etc., you can add this step of putting your capital as premiums to a life insurance policy. Also should be viewed as deposits. So you're making deposits by paying premiums into a private asset that you own and control, wherein you can access capital when you want for whatever you want to deploy it for, employ it for, to do. Okay, so you're deploying the capital, you're employing it in whatever it is that you're doing as a household. Use those funds in your small business, use those funds for the investing that you do, whatever it is that you're doing. Vacations, a lot of the shuns. If you've heard me try and list out just to provide some ideas, medications, vacations, institutions, furthering your education, whatever. So you can employ that capital for what it is you're doing, but because you own that entity and because you're practicing privatized banking, now you can recapture that principal. You can recapture profits if you're earning from this venture that you're employing your capital for. You're not bleeding out interest dollars now to the third-party lender. You can recapture interest dollars back into your privatized banking system. So just by adding that one step of obtaining a properly structured whole life policy with a mutual company and knowing how to use it, you can just add that one step, and now you're not just in the business of what it is that you're doing. You're in the business of financing what you're doing as a household or a business owner, etc. Just by adding that one step. So by procuring such a policy, you obtain as the owner of that policy the contractual right to pay premiums long range into the future. Again, the more you can wrap your mind around paying in premiums, again, view those as deposits into your private banking system, the more you can wrap your mind around paying, and the longer you can wrap your mind around paying, the better off you're going to be. Here's why I say that. Is there any point in your life that you want to be less capitalized or under capitalized? You want to have less access to money or less money to access? Either and both of those. Me either. I always want to have a growing amount of money to access, a growing access. This one's contractual because a policy is a unilateral contract. So you're procuring the right to amass capital where you can compound those premiums for the rest of your life, all while leveraging that capital as well in that policy for the things that you want to finance, because it's your policy. You own it. From the get-go, it's got guaranteed death benefit, guaranteed cash value, guaranteed right to access that capital, etc. So you have that contractual right to compound also while leveraging. It's a beautiful situation. And that's why it's the superior entity for implementing the infinite banking concept. Now, when I said long range just a second ago about paying long range, paying for a long time into the future, as far as you can wrap your mind around, what I'm trying to point out there, and again, whether you're vetting this idea for the first time or whether you're already a client, have policies, you've implemented this idea, let me go back to asking some questions about how long. Again, we've already said we want to have a growing amount of capital to access, and we always want to maintain a contractual right to access that and to grow it. See, that's what I'm getting to, is when we got our first policy, my wife and I, we were deciding to pay a significant amount of premium for us at that time in our lives. We had student loan debt. Our second son had just been born. We had a car note, credit cards to pay off. We had a lot going on. We were pretty average in that regard, much like what Nash describes in his Becoming Your Own Banker book. But we arrived at paying what was for us a significant amount of our cash flows, very significant. And we decided to be able to pay that long range for decades into the future. Now, I'm not trying to make a blanket statement either here in general. There is the principle that we should be thinking long range, and also we can't hesitate to capitalize. But I'm also trying to clarify that I don't have a cookie cutter approach to structuring policies properly. Everyone's an individual. Your case is different from mine. My case now from 7 years ago when we were getting that policy is different than so. Okay, but we decided to pay a significant amount of premium for a long time into the future, and having that contractual right to be able to warehouse our wealth. Now, I'm using that phrase in particular because Nash's second book is called Building Your Warehouse of Wealth. When you realize that wealth must reside somewhere, it's going to reside somewhere. Who do you want to own the entity where that's residing now and into the future? So we decided to pay significant premiums for a long time into the future, and we maintain that contractual right to this day is what I'm pointing out here. And I don't want that to diminish in the future. And really, when you think about it, because, and I mention this, we're talking about this right now because there are so many folks that'll say, well, pay for, 4 years, 5 years, 7 years, 10 years. And then that policy is going to be capitalized, and then maybe you should begin paying less premiums into that and move on to X, Y, or Z. Again, wealth must reside somewhere. Do you plan on earning less in the future? Do you want to earn less in the future? Do you want to have less access to capital? Again, just think about that. Think about that. I mean, we got our first policy when we were something around 30. So traditionally, I mean, all you got to do is look at retirement age. When do you want to stop having the contractual right to pay the kinds of premiums that you choose? Again, remember, I chose the premium amounts. My wife and I were the ones that were going to own this and operate this, and we're making these plans and getting a policy structured for us. I mean, when you think about the peak incoming years that folks experience, it's normally later on. You know, we gain experience, we expand our network, we improve our skills, all these different things that naturally tend to happen. In general, I understand that I'm also speaking, in some generality here. But again, I've already clarified by saying every case is specific. But let's not ignore that our peak income earning years tend to be later on. And having a contractual right to continue paying premiums that, again, are going to just compound, and that policy is just going to become more and more and more efficient as time goes on. Again, when you realize that eventually, whatever the death benefit amount is, the face value of a policy, the cash value must eventually equal that number. Well, then you just got to start asking questions like, well, when do you want to start that process? How big do you want it to be? How many of those do you want to have? Okay, because eventually that cash value that we can access is going to eventually equal whatever that death. And again, if that death benefit is growing because you're doing good with dividends, you're buying additional paid up insurance with your dividends, and both these numbers continue to move, they still have to eventually meet. But if both of those numbers continue on an upward trend over the course of your lifetime, that's obviously ideal, and what we're talking about, and the way things should be, the way that those numbers get theirs, from the start, based off of, the amounts of premium that you decide to pay, for how long, what are you doing with the dividend. So that's why we're talking about all these things. But maintaining a contractual right to pay significant premiums, whatever that happens to be for you, for as long as you can wrap your mind around. Now, this would be a good point for me to differentiate between, so as the owner of a policy, such an entity, you have certain obligations. So you are obligated to pay at least, and there's a minimum amount of premium, whatever that contract is, to maintain that policy in force. You've got to pay premiums to have a policy in force, like you got to pay for anything else. Okay? But of course, we're viewing this as deposits. Now, if there's a time where you want to elect because you choose to, and by choose to, here what I'm describing is, what if you had a windfall of money and you wanted the ability, again, to warehouse that somewhere? Awesome. It's great to have built a system of policies. What if you get to passive income years and you're perhaps not going to be fully funding that policy as you have been before for various reasons, because the policy can be funding itself from its cash values. So that's not having to come out of your cash flows. It's not having to come out of your pockets. And in fact, you may be withdrawing or taking policy loans to supplement your income, to supplement your cash flows. So again, the whole point here is that you can be your own banker. You can be making all these choices and decisions. But again, you wouldn't want to prematurely stunt the potential growth of a policy by not having the contractual right to fully fund. Now, if you need to, and a hard time, or by choice for various reasons, again, withdrawing passive income, what have you, or just allowing the policy to pay for itself, if you decide to only cover the minimums required to maintain the policy in force because it's just reached such a level of efficiency, or perhaps you're having a difficult time in your cash flows, you can always pay the minimum because you're not obligated to pay the full amount that you have the right to pay. Okay, and I hope you're following me. I'm trying to explain this very clearly, but again, of course, you can always have a direct conversation with me. But again, between this discussion here and the private ones we have, what I'm getting to is ultimately it matters how you start. It does. It matters how you start. A policy should be robust enough to accomplish things that you want both here and over the course of your lifetime from the start. So it would have to be structured a particular way. So again, that would be why you need to know a good professional. Hello, my name is Jesse Durham, and you can have a policy started well for you from the very get-go. And when I've been talking about this concept from the start of this episode of adding rockets to what it is that you're doing, that's on purpose for various reasons. One is because I remember the very first time that I saw a presentation, the very first time that I was introduced to becoming my own banker, and I saw a presentation about this idea. The most common parts of a properly structured policy were laid out visually as a rocket ship, meaning that the premiums are split up into two main portions. There is a base policy, which is the whole life insurance policy, and then a rider that can be put on that policy is a paid up additions rider. Now, that base policy shows us and dictates the minimums, of course, for example, to have a whole life insurance policy, to have a policy, a guaranteed policy in force. And there are also maybe some minimums to have the paid up additions rider maintained on the policy, of course, but it allows us to add additional premiums, additional premium payments into that policy, and they do create a quicker cash value growth than the premium dollars that are paid into the base portion of the policy. So the analogy was, well, the rocket shuttle is the base premiums. That's what's going to launch off, and that's eventually what's going to take us all the way home, if you would allow me to use that terminology. Nash, when he would talk about passing on from this life, he would use the term graduate. And he talked about where he was headed, and I'm headed to the same place. And the rocket ship, when you think about it, when a rocket ship launches, it takes off, goes up, and then, of course, it accomplishes its mission to the moon or what have you, and then comes back, lands back home. But it's not just the shuttle at takeoff. At takeoff, there are these additional rocket boosters that have this additional fuel and thrust, and they help that rocket ship break away from the gravitational pull of the Earth, of course, and breach through the atmosphere. But when they have been used to their capacity, they drop off. Okay, they're not necessary now that we've broken away from gravity. We're in outer space. Okay, the propulsion has broken us away from the pull of the Earth's atmosphere. There's a lot of efficiency now that has been gained. Okay, so I hope that you're seeing the parallels that I'm talking about. It certainly is the case that you may not be able to pay a full amount of premium that you're used to from the start of a policy over the course of your lifetime, nor would you necessarily choose to. Again, if you get to retirement age, decide you want to have passive income, of course, and again, the policy has achieved a certain level. I mean, it just gets more and more efficient. When you've had a policy and you've gotten to even past that first year, you see what it looks like. You get past year 5, you see more of what it looks like, year 7 and on. And that rocket ship is an analogy that was used from the very first time that I was exposed to this idea of becoming your own banker and learned about this concept. So I still wanted to use that to describe a bit about how policy structure matters and maybe a helpful analogy to think about it, especially again if you're vetting this idea. I mean, how much premium do you want to be able to have the contractual right to pay, for how long? And again, every case is going to be different, but again, the longer range that we can think, the better. I mean, to go to the moon and back, that's a big deal. That's thinking long range for sure. And there are these moving parts. And again, that's why it's good to partner with somebody who doesn't just have a license that could be procured over a weekend, of course, but that has actually implemented this idea into their lives, has actually used these concepts in what it is that they're doing as well. You know, my experience has been, I had 5 years, I guess, of just being a consumer, just buying and using these policies the way that we'd heard about and read about from Nash's book. And then over the past, few years now, I guess, the time that we were spending answering people's questions, mentoring, coaching, just being on the phone, helping folks, it just made sense to do that professionally. And we have been doing that more and more and more and more, of course, all the way to, having video and podcasts and everything else to just speed up everyone's learning curve from everything that we've gleaned from our learning, but also from our own personal experience over these past several years. So again, let me clarify. Premium dollars are premium dollars. They grow the death benefit. They grow the cash value in a policy. I can't make too many deposits into my own privatized banking system. Premiums are those deposits. I want to pay as much as I can for as long as I can into as many branches of my privatized banking system as I can. Now, when we're talking about the base portion of a policy, when we're talking about the whole life policy itself, dividends, I just want to point out some key factors for the folks that really like the nuts and bolts out there. Dividends are earned more so from the amount of base premium dollars that we pay. That's important to know. Also, the base premiums do not provide a lot of cash value growth in the earlier years of a policy, but they do more so in general in the later years. Now, again, premium dollars are premium dollars, but I'm trying to give you some nuts and bolts here. So the premiums to the base portion of the policy provide that long range growth that continues to increase the death benefit, that continues to procure more dividends from the general performance of the company over the course of the year. And that would be the rocket ship in this rocket ship analogy. And also, that is the obligatory part. That's your end of the contract. Your end of the contract is you agree to pay a certain amount of premiums, of course. And then everything else is on the company. That's why it's a unilateral contract, because you're saying, well, I'm going to pay these premiums and you're going to be providing this death benefit, this cash value, this access to the cash value, and this known interest environment, et cetera, et cetera. So that's the obligatory part. Now, the contractual rights that you have associated with a paid up additions rider say that, okay, well, you can pay these additional premiums and they will, and these are the rocket boosters on either side of the rocket ship. These premiums create an early and immediate, and by immediate, I mean within 30 days of policy going in force, it's possible to access capital from that policy. And it's because of paid up additional insurance premiums. So premiums that have been paid up to buy insurance, they have early liquidity. So again, with our first policy, 7 whatever years ago, we paid premiums within 30 days. We were accessing capital from our policy to be able to pay off student loans, etc. So those are the rocket boosters that can last for a varying amount of time. And that's why it's so important to have a conversation with the appropriate professional, because you don't get that from a box store, box name experience. Okay. That's all about quotes and getting you the best price. And it's not about banking. It's not about compounding. It's not about what we're talking about right here for sure. So those premiums into the paid up additions rider, they provide an early liquidity, which offset the liquidity that you don't see in the base premium in the beginning. But I also want to point out that there's not a loss of value. There are plenty of folks who will say, as soon as you mention anything about whole life, they're going to say, oh, yeah, well, for 10 years, 15 years, you're not even going to see any kind of a cash value. Not so. Not so. I understand why they say that. But again, most people's understanding of whole life insurance is based off of someone else's misunderstanding. So could you go to a box store and just say, I want whole life insurance, and have a policy that gives you a guaranteed death benefit, but that has zero cash value right away and for years to come? Yes. Yes. So is that so? Yes. But is that so in every case? Well, no. And that's why I talk about properly structured whole life policies with a mutual company that pays a dividend, because those are apples and oranges. Apples and oranges. Just like a Prius and an F-350, they're both vehicles. They are not the same. So no matter which one you like, they're just not the same. So it's apples and oranges. So what I was trying to say is that when folks say that for years and years you won't even have a cash value, I understand why they're saying that. I want you to understand why they're saying that, but it's not the case with a policy that's been structured for the banking purpose. Now, I would also point out that in any kind of whole life, there is not a loss of value. Nobody's keeping your money. There are folks that want to say that even when there is a payout, there's only a payout of the death benefit and the insurance company keeps your cash values. That's a misunderstanding. It's simply a misunderstanding. Unless someone does understand it and then they're saying it maliciously, which I don't know. But at least it is a misunderstanding. And the way to know that is look at the value of a home. If equity is built up in a home and you sell that home, you don't get to keep what the home sells for and the equity. The equity was just a net representation of the house being sold. So if there was something owed on the house, but it had built up some equity, then that mortgage is paid off and you keep the rest. Okay? It's not both. So it's a misunderstanding. So there is not a loss of value, but there is a loss of liquidity just on the base premiums. But again, with a properly structured policy, you have access immediately within 30 days of a policy going in force to capital. So I hope that rocket ship analogy has been helpful. Make sure to let me know down in the comment section what your biggest takeaway from that rocket ship analogy was, or question. I mean, I can remember because I had a lot of the traditional financial products, both from my law enforcement career and from my teaching career. The 401k, the retirement programs. We had some work term insurance. We had some whole life policies that we'd bought from a box store on myself, on my wife, on our first son. And that was all before I'd ever read Nelson's book, all before I knew anything about life. I just knew that life insurance was a good idea. And when I went in to get something, because I was trying to do above and beyond even, what the employer was doing, I was trying to do well, of course, for my family. And I went out and I decided on, permanent guarantee. Okay, that sounded good to me. I did that. We got some 20 pay policies. Okay, you pay for 20 years, and then sure enough, at the end of that, you have some cash value. Oh, okay, all right. So you only have to pay for 20 years, and then you're done, and then there will be some cash value on these policies. And now looking back, we don't know what we don't know. That's one of my favorite quotes. I've used it and heard it for years. You don't know what you don't know. But also on top of that quote of what most people think they know just ain't so. Well, there's another level. Sure, we don't know what we don't know. We're not taught at homeschool work about life insurance and many other valuable things, no doubt. Okay, we're not taught about life insurance. And what we are taught, what we are inundated with from the financial world so very often, is a misunderstanding. Not that we misunderstood, but a misunderstanding was propagated to us. So I'm thankful for my experience. It's been an incredible learning journey. And of course, I hope the same for you. Now, what we're talking about is, the and asset is what a banking policy has been described as. It's been called an and asset because it's everything. You get the guaranteed death benefit. You have immediate access to significant capital for providing for our need of finance. And who owns it? Who controls it? Again, who didn't have to change their cash flows? Who didn't have to assume additional risk, expose themselves to market volatility, etc.? Me and you. So again, I hope that this rocket analogy has been helpful. Again, let me emphasize that if you're vetting this idea, or if you've already begun implementing this concept, either way, this rocket ship, it really does add of infinite banking. It really does add boosters to what it is that you're already doing. Again, if you're a client, you're already experiencing this. If you're implementing this concept, not just owning a policy, right? You could own the rocket ship, but if you're not using it, if it never launched, if you never use it, okay? So a policy is going to do what a policy is going to do, a properly structured policy. But implementing privatized banking, that's what this is all about. That is what is the most profitable thing that you could choose to do over your lifetime, is to study this thing, learn about it, put yourself in that position, launch. If you've been watching, if you've been listening for a while, and we haven't yet had a conversation about what this could look like in your home, in your business, or your investing, let's have a conversation. A rocket ship doesn't accomplish any missions sitting on the launch pad. But when you launch this thing, again, it's for the whole lifetime of that mission. Our mission, this lifetime, I believe there's a life after this one. You want to talk about that? I'd be happy to talk about that as well. But for this whole mission of this lifetime, the most profitable thing that we could choose to do is to implement this concept. And then how much better off does that set up the next generation and the next and the next? So again, I hope that this has been helpful. I look forward to our next conversation. If you'd like to contact us about a free consultation to discuss what this could look like in your situation, then you can contact us at 828-817-4223, or you can email durhamtalents@gmail.com. I've enjoyed this very much. I look forward to our next conversation. Have a great day. Take care.
Hello and welcome to the Durham Talents channel. What time is it? It's time to be rolling. Let's go.
La donne Moppy.
Señorita, how I have longed for this moment. Allow me to introduce myself. My name is Puss in Boots. Rocket boosters for life. Pun intended. Life insurance. Rocket boosters for life. Life insurance. Oh, that's funny.
My name's Elmo. I'm learning about banking. Do you want to learn about?
That went really high.
My name's Elmo. I'm learning about banking. Do you want to learn about banking? If you would like to have a conversation with with Jesse, call us. That's hard. It's hard to use this voice. It is. And we'll have to work on it.
All right, that's good.